Hey, Jeff Scott here. Welcome to this week's edition of the Top Down Review for November 15, 2015. You'll notice down here it is 9:20 in the morning, so futures are not yet open. I entitled today Breakdown. Actually, I had written this even before we had the tragedy in France, and that may set up for an interesting morning on Monday. We'll start with the slideshow as always. This is for education purposes only. Anything I recommend is in the spirit of education, not investment advice. I'm a doctor, not a broker. I am not affiliated with any software vendor or trading company. Tools demonstrated are those that I use in my daily trading. I have paid for all the tools I demonstrate. Trading involves risk, and you alone are solely responsible for any investment decisions you make. My world of trading, I've sort of cleaned this up a little bit over the last couple of weeks. It's really two. It's the world of canceling on the left, and then actually taking that and then learning how to trade and actionable signals and a couple of great indicators from John Person, author, trader, teacher, and friend, and then position management as taught by Van Tharp. I have lots of programs. What I need in my desert isle will be TradeStation and or Thinkorswim. I love Genesis as my real-time charting platform. It's the most flexible of what I own. Problem is own. It's about $2,000 to be all in, plus you have to pay for data, and it's not for everybody. I'm the first to acknowledge that. For analysis, I live in HGSI and EdgeRater. I do like seasonality with various different programs, and I use a couple of different websites. Just hold one second. I'm going to close my door because my wife's got a loud voice. All right, sorry about that. I always start to look at my sector review to get a sense of where the market closed on Friday. I don't need to tell you it was weak. It looks like the only place there was any strength was in materials. A lot of the chemical stocks look strong. They do benefit from low energy costs. Now, it doesn't look as impressive here as it did earlier in the day, but there was at one point some strength in biotech, and there still was strength at the end in some of the smaller biotech companies. Major markets, as always, I've got the E-mini, NASDAQs, the YMs, the TFs, the VX, and the dollar. You could see we are testing major support, or we've broken through support on the E-minis, heading down towards the 50. The 200 did not hold. We are coming up to the 200 and the 50 on the NQs. We broke the 200, heading towards the 50 on the YMs, and we are broken below the 50 on the TFs. That's weakness, and that's across the market. And that's a pretty dramatic change from a week ago. And this is before we go into the setting of the post-Paris terrorist attacks in the morning. You could see the VIX started to spike up on Friday. Would not surprise me to see it go back up at least early in the day on Friday. And I hope I remember to come back and talk about trading VIX instruments. These are definitely you trade at your own risk. And then the dollar, you can see the dollar here moving up, especially if we see easing in the EU and rest of the world, while our Fed continues to be more hawkish and talk about raising rates, which frankly in the setting of worldwide concerns about growth is sort of, they missed the boat when they could have raised rates, and now they're talking about forcing it into us when the market probably will not be as welcoming, let's put it that way. I can look at any time frame, again, E-minis, NQs, TFs, NYSE, and YMs from left to right, and this is, I believe, a 60-minute daily and weekly charts, and you could see Friday was just a ski slope down from the open, and closing at the lows of the days was sort of a crescendo at the end of the day. One might expect that to continue into this week. Now, we are on daily sells across all these indexes, but we're still, except now in the Russell and the NYSE, where we now turn to weekly sales. So daily sells across and weekly sells in the Russell and the NYSE. One notices that rates fell last week. That's good for REITs, MLPs, utilities, dividend payers, and home builders, but frankly, they all looked weak on Friday as well. A lot of banks had the same type of a pullback with rates coming down. Banks, especially regional ones and insurers, really like rising rates. Now, the good news is compared to where we were in January of 2015, rates have come up a lot. Now, I'm a believer that these rates are changing now more on the sense of the economy. And when we get bad economic news like a negative PPI, the rates drop. Hard to believe in the setting of the news and the retail issues that we're seeing that rates are going to be risen by the Fed. AD lines have recovered quite a bit, but they turned down again on Friday. You could see breaking down below support. On the daily, weekly doesn't look so bad yet. If you look at the number of stocks trading above the 200-day moving average, this is a trend line which I'd written a long time ago, because if you went back to 2003, you'd see there is some validity to that. You notice that we've come back to test that trend line here. And then the stocks above the 40 have come back down as well. This, where my arrowhead is where markets seem to reverse. This might tell me that we have more downside coming. Canaries in the coal mine, we like to look at the major leaders over the last period of time, Facebook, Netflix, so on and so forth. The FANG stocks of Kramer Plus, this is something that Ian came up with probably 3 to 4 years ago. They hit a high with a doji about 1, 2, 3, 4, 5, 6, 7 bars ago, and they've sold off hard. Look at that big red bar on Friday. We follow these because they seem to give us an indication of what the overall market's going to do. If this was my stock, on one hand, I'd be very nervous. I'd be expecting it to pull back to that blue line, which is the 50-day moving average. It's short-term broken, but still intermediate and long-term trend is up. So will we hold at the 50? Will the market hold after another pullback and go back to new highs, or is this for the end of the year? Remember, patterns are cyclical. If you don't believe this pattern occurs, just take a look at Dry Ship's rig and many of the other high flyers that are licking their wounds of late over the last couple of years with major falls. Where are we? Gosh, I said last week that I kind of think we're sort of stuck right up here. And we go from looks good to looks bad, back up, back down, and we're stuck pretty much in this trading range, which reset at a lower bar. I feel right now, at least to open the market, we're going to open down. But we are in a seasonal strong period of time. It is unusual to see a down year in the 7th year of an election cycle. But right now, I have to feel pretty pessimistic that we're somewhere on the side where we need to have caution. That means you need to adjust your game plan, folks, and take less risk here. And this is sort of my game plan of different things that I do when I'm bullish, when I'm not sure, neutral, and when I'm bearish, I have different approaches to the market. Short-term markets have turned ugly and likely have more challenges in light of the Paris attacks. Volatility is increasing. We've gone from overbought to oversold, and one wonders, will equities follow the commodity collapse? Longer term, still looks like 2011. Is this correction over and we're still in a topping period? I think in the big picture, when we stand back, we've come a long way off that bottom of August 24th, and backfilling here and pulling back isn't a big shocker. But I do still think that this is an old bull, and we'll have to see when we actually throw the bull out and accept the fact that it's over. Again, I talked about the Fed a little bit. Be careful. And this is where major bottoms have already occurred usually by the time we get to November. And we'll see if that August 24th low holds. Speaking of August 24th, I wanted just to talk about what we might see tomorrow and how I personally am going to manage it. This is going back to August 24th. The peak of the day in August 24th, which I think was like 1930, was at about 4 in the morning. And I'm not sure if that's when China had their big dump, but I believe I remember correctly. I went to sleep. The market didn't look that bad. I woke up and our futures were down a couple hundred points. Now, the important message here is that this is the futures. I could look at the E-mini at the spiders as well, and I will in 1 second. I think I made a picture of those. But what I really wanted to point out was the market bottomed at 9:32 in the morning. What do you think happened between the open here at 9:30 and the bottom 2 bars later at 9:32? Here's what I think happened. I think our stops got run. I think if you had 10, 20% stops, 5% stops, 8% stops, your stops got taken out. And you might have felt good at 9:40 that you had stops in place, but by the end of the day you felt sick because many of your positions had gotten taken out of prices that you would die to buy the stocks for. I am taking off my stops before the market opens. Stops don't protect you if there's a big gap down. If there's a big gap down, you are likely to get filled right at the time the market starts to reverse. What I did on August 24th, because of the chat room that I had was with John Person, I started looking at some things that I might be interested in buying if the market takes a major dump. So I might put in some buys for Facebook at $80. Now, do I think I'll get filled? I kind of hope not, because that means the market has another one of these crazy flash crash starts. But I did get filled the last time. I might look at Netflix or Google or Apple, any Amazon, any of the very liquid stocks, and I might put in some buy orders at some ridiculous prices. Now, again, I kind of hope none of them get filled, because it really means the market will have collapsed. But on August 24th, I got some crazy fills when I did that strategy. Now, the other thing to be aware of is there'll be margin calls, there'll be forced liquidations, and we'll see how long it takes for the market to bottom and go up. But take a look how fast we got to the bottom. I'd rather be selling at that bottom at 9:32. I mean, rather be buying rather at that bottom rather than selling. So I think you have to be aware that the market's potentially going to flush at the open on Monday. I hope I'm wrong. All right, I'm guessing. But I think that what happened in Paris is going to spook a lot of people. Now, the fact that it happened on Friday and the market opens on Monday, perhaps that spooking's already worked through the system. And if the market reverses like it did on August 24th, then that tells you that the market is already digested by 9:35, the big impact, and it started to head back up. So we may have digested, we may not see it. But I'm leery of this. I'm going to take my stops off. I'll put them back on after the market is stabilized. But I'm going to expect, if the market flushes, that it's going to quickly bottom and then start to move back up. Doesn't mean it's going to be higher a week from now or a month from now or a year from now. It's just going to be higher than it was at the low of the day yesterday, and my guess is that low may come early. Play it the way you want. It would have been nice to have sold everything on Friday and be in cash. If I'm sitting in cash and I'm not in enough, I have cash, but I'm not fully in cash, I might be sticking some things out there. Now, if I buy Facebook at 80, and I get filled, say 1,000 shares of Facebook at 80, and Facebook closes at 65 because the market just implodes, I may be upset because I'll have a paper loss, but I'll feel pretty good that I got into Facebook at a really good price. Now, what happened on the 24th was I couldn't get in. After the market opened, it was difficult to get into Thinkorswim or TradeStation. Executions were horrible that day. The market was all over the place. And the only positions that I could say I was happy with were the ones I sat on my hands on and those that I had put pre-market stupid orders in, and they got filled. I couldn't make orders once the market opened because of the volume traded and the lack of capacity of the TOS and other platforms. Just a few thoughts. I did say I'd look at the spiders. I don't think I could look at it when I'm doing this. All right, so I'm not going to look at the spiders. Sorry about that. The spiders, the difference in the spiders is the spiders don't trade after hours, but the spiders looked very similar. Know your news and EPS dates. When I look at the news, I see CPI, and it's kind of interesting. I think it was minus zero point 0.4 in the PPI. If we miss to the downside on CPI, I don't know how you raise rates. We'll see the FOMC minutes on the 18th. They'll probably be market moving, and we've got some leading indicators and some energy. The good news is the earnings flow seems to have slowed. It's not to say there's not some biggies here, but compared to the last couple of weeks, a relatively gentle week on earnings. As usual, those are my introductory comments. Let's go take a look at the market, top-down approach, and let me just tell you there's not a lot of stocks to buy right now. Chart of the week, this has become dangerous in a trending and volatile market, but each week I identify one chart that meets my criteria, and I talk about how I'm going to trade it, and then I show you the results the following week. I don't warrant any returns. I don't guarantee that I'm going to take the trade. I may already have the trade. It's just for educational purposes only. Last week, my choice was beat in the healthcare technology space. Medical equipment devices, I liked it for a number of reasons. By technical indicators, it turned green. It had broken above the 50. Just came out of a mobile breakout and a squeeze, had some pocket pivots and a kahuna. Now, when I looked at it, I said I'll buy it at 1430. That is the white line, which basically takes out the high of the prior day. Target was 1560, my stop at 13. I did not get filled. The high of the day was 1425, or I believe, on the first day, and then the market sold off thereafter. So this will be a total wash with no fill, and this trade is no longer pending. Hope to see you sometime next year at one of my meetings in Florida. More to follow. To be transparent, I have started another business, and right now that's occupying a lot of my time. My hope is that as the year goes by, I'll have more free time and I'll be able to think about having another live meeting. Let's look at, now the cynics and you may wonder, if I'm such a good trader, why would I start another business? Well, the last business I sold for a lot of money. If you can always Google me to figure that out. But I miss the game of being on the road and of selling and building something, and the negotiation. I wasn't ready for retirement. That's kind of why. Not about lack of funds or lack of returns in the market. It's just I wasn't ready to stay at home. Of course, my wife was ready for me to stay at home, but that's a different story. Let's take a quick look. It's going to be a dirty look and ugly. We've gone from buy signals throughout to now the elder bars have turned red. Remember, elder uses the color of the paint bar as a screen. A red paint bar allows him to short or hold. A green paint bar allows him to buy or hold but not sell. And a blue, he can do whatever he wants. You can see we've gone to red paint bars on the NASDAQ on both the daily and the weekly. Although we're still in a weekly buy, the daily has gone to a person sell. If I look at the Dow Jones Industrials, red, blue, and green, so you still have all the colors represented. The shorter terms are weaker in a daily sell, still in a weekly buy, monthly green, but a monthly sell on the person indicator. On the 100s, you can see they have S&P 100 is rolled over. Let's take a look at the S&P 500 cash market. Weak, a person sell on both the daily and the weekly, and the elder has gone to red on both. And if I look at the YMs, or let's look at the IWMs rather, like the S&P, just this is weak. Everything is red on the elder, and we're in sell signals. I could go through all of them, and all it's going to tell you is the market is weak. Certainly short term, but spilling over to the weekly, and in the case of the small stocks, the monthly. If I look at the sectors real quick, materials, weak. Short term sell, although the weekly is still in a buy. If I look at energy, short term sell, this was some MACD divergence where it was probably getting a bit ahead of itself. That's the little dots. Contrast here on the weekly back at the beginning of October when we had the big up move, you had some MACD convergence where you were suggesting that the selling was slowing down. Energy looks weak. Finances, as soon as the economy softened and it looked like the Fed may not raise rates. Went to a sell signal and sold off. Intermediate time on the weekly is still on a buy. Industrials in a sell signal, still in a buy on the weeklies. XLK, which is technology, sell signal on the daily. Staples, deep sell here. Starting to see some divergences on the weekly, but those are divergences that would suggest we're coming down. Utilities, the only thing that's blue but still in a sell signal on daily and the weekly. Healthcare in a sell signal on the daily, still in a buy on the weekly. And then discretionary, big down day on Friday, sell signals on daily and weekly. Hard to be excited by anything that I just saw there. Broad-based weakness across the market. Let's go into HGSI. I updated some of my things over the weekend to the most current, so my charts may be all over the place while I sort of get used to, because I bring them over from another machine and on an archive, and I have to resize everything. All right, so at the end of the week, strength was in the VIX and the dollar. Never good for stock investors. The NASDAQ biotech shares were the leading on the equities, and the small stocks, although they had weakness, were actually up on the week. Let's look at the 5 days, first of all. The only equities that were up, small stocks were up on Friday, rather, it looks like. The VIX was up 40% over the last 5 days. Gold was up a little bit. Utilities and bonds were flat. That was over 5 days. Yesterday, you can see that, the small stocks were not up. The biotech was the one equity that was up 1.1%. Let's take a look at some of our favorites. S&P 500 to start. Just to review, there were kahunas on the day before, on Thursday, and there were kahunas in a number of indexes. But let's get out of this view. Actually, let me just make a few comments. Sometimes you just got to step back and get an idea of how bad things are. Well, clearly stepping back, and this is only to 2013, so this is a little bit over 2 years. We've still been in a major uptrend. This was a pretty deep pullback. I've commented several times that it reminded me of the pullback in 2011. And as you can see, we did have multiple pullbacks, although not as deep, as we moved our way back up, and this was at the end of November. It led to a pretty big rally at the end of the year and into January. So we've been in a long-term uptrend. Compared to the August lows, we are way off the August lows, and we had a nice return off of the September lows. But now let's look at where we are today. We've had 3 down days in a row. Here is the 50. Clearly, my target has to be that 50, which is about 17. I'll tell you exactly what it is. The low on Friday was 2022, and the 50 is sitting at 2007. So that's a 15-point move to get to test the 50. It wouldn't surprise me to see us knife through that and maybe come back by the end of the day, as I talked about earlier. So not much to like up here, clearly in a downtrend. Take a look at the Dow Jones Industrial. Kind of looks the same. Again, the obvious target is the 50. Take a look at the Russell 2000. A little bit stronger than the others, but that's interestingly stronger compared to what? Because it's already broken through the 50. I guess the damage on Friday was less percentage-wise than some of the others. On Friday it was down less than 1%. And then I can look at the Dow. Let's just look at the NASDAQ. And the NASDAQ was actually on Friday actually looks like it closed up. Actually, that's biotech. NASDAQ biotech closed up over 1% on Friday. I mentioned the strength there. And the NASDAQ composite's going to be a little bit less beautiful. I know it's right in front of my face. Sometimes you look at it, you don't see it, even though it's hitting you in the face. NASDAQ has broken down the 200. Its target is the 50. So will those 50 days hold? I think that's the big question. I didn't comment much on other things, but notice how OBV has broken down on all of these. Okay. A couple other things that we like to look at. The VIX, as I said, it's broken out above the 50. It had some kahunas. Would not shock me to see it go back up here, certainly early in the day on Monday. And then we could look at the dollar. Didn't do much this week, kind of flat, but in the setting of falling equities, it outperformed. Dollar's doing okay, then one can guess that gold and silver are not. Here's gold, trying to put in a bottom perhaps, and here's silver, neither of which look real attractive to jump in and buy. Now, I made a comment earlier about things like this. This is a VIX ETF. So the most bullish looking chart that I saw was the VIX as far as if I wanted to go long. Cash isn't a bad position either to be in, and that would be the dollar. Now you look at this and you go, wow, I mean, I got to get through the 50. My target could be the 200. I look at where I'm sitting right now on UVXY, which is a ultra short, so it's a 2x of the VIX. I closed at 37.41. The 50 is at 41, so that's 10% move. And the 200 is at 54, which is 13 on 4, which is about a 30% move. Those numbers are not unattainable. Here's the problem with UVXY. This is a daily chart. This is a weekly chart. Tell me how you made money on this chart. You got to be really, really good. In fact, let's just look at a year ago. How much would this have been trading for a year ago? On 11/23, that's not where a year ago is. How about, it's weekly, so it's going to be this. All right, weekly on the 16th. It opened at 6,174. The high was 63.86. It closed at 5,474. How do you go from a 5,474 move down to a $35 price? You have a falling knife that keeps doing reverse splits. Would you like to have been long from 5,474 on the close of the week before Thanksgiving a year ago to 35 today? I don't think so. These are not investments. These are not safe. These are not recommended. These are short-term instruments that you buy and sell over a short period of time to either hedge your portfolio or take advantage of a short-term scenario. Yes, if you can buy it before it, and here's the key word, before it gaps open on Monday, and let it run up to 50, which it very likely will, and sell it before it's back down to 35, you will make money. If you buy it and put it away with the belief that it's going to grow back to that $4,000 over the next year, you're obviously smoking something, because you're more likely to see 10 more reverse splits, and the only way you'll be seeing 40 a year from now is after it's split 5 times, reversing. All right, enough said. Just be careful with these, and I speak from bad experience. Look, does it look exciting here to have bought down here on this doji day and sold it up here and to have made 241% in 9 days? Sure, George Lee can do that. There are some people, Dave McMullen can do that. Not everybody can do that, because if you didn't, most of us would have probably bought here and ended up selling down here, and you could have lost 50% in 17 days. These are not easy things to trade, and you trade them not on my recommendation, but at your own risk. I think we already know the market's poopy, but let's just take a look at some of the things that I saw on my review. Shitty market. And usually I try and hide sometimes my own holdings, but remember these things are what was sitting in my portfolio a week ago, and it just gives me an idea that if I hadn't left my portfolio alone, this is kind of where I would be sitting a week later. So for the most part, my portfolio looks totally different, and it certainly has a lot less positions and more cash than it did a week ago. First thing is, and again, there's no stops in this analysis, and things get stopped out along the way. You notice the sea of red. This was a bad market. HGS 100 was down 5%. So I know that my portfolio was going to get hammered. Top 100 Vector Vest was down 5%. My buy watch was down 5.8%. The best of Woodward and Brown was down 6%. My filtered buys were down 7.5%. My top stock search was down 10%. The S&P 500 outperformed comparatively. It was only down 3.63%. There was one winner, and these were long bullish pullbacks, and two losers, one winner. But there must have been something good on that winner because, Barrick Gold was up 6%, and that was the only positive group. I don't know how anybody made money playing long last week unless you were long contra ETFs. No Hindenburgs. Remember, you have to have a number of things positive. You need to have new highs less than twice the new lows. You have to have McClellan has gone negative. The moving average, and in this case I'm tracking the spider, has to be positive, rising. And both the new highs and new lows have to be greater than 2.2%. What we have here is 3 out of 4, and the reason we're not at Hindenburg risk is because we don't have enough new highs. The Hindenburg is sort of a top of the market. It's when the pros are selling as the market's making new highs, and we're buying, we're the last ones in, and then the market rolls over. It's a sign of a market top. We're not near the top, so I don't expect to see one. The last Hindi we saw was July 23rd. The buckets are starting to show some oversold, but we can get much worse. 75% of the stocks in the S&P 1500 are trading below the midline, and 15% are trading underneath the lower Bollinger Band. The markets, as I mentioned, there were some kahunas to the downside, and you could see them showing up on Thursday and Friday, and the Woody buy-sell indicator has gone now to decidedly red, which is not bullish for the market. Now, that's a lot of bad news. I'll show you some good news. Seasonality, we're going into a strong period of time, as I've been saying the last couple of weeks. And these are just some of the stocks that looked interesting. So, for example, IDEX Corporation, haven't looked at it closely, but I could tell you it's been up 18 out of 20 years, an average of 5%. Grade Television has been up 14% on average, 11 out of the 13 years. Pilgrim's Pride has been up 13%, 10 out of 11 years. Gramercy Capital has been up 8% average, 10 out of 11 years. So there is some strong seasonality. Chimera Investment Corp has been up only 2%, but it's been up 100% of the time. So there are some potential up stocks coming. There are also some that are big losers. Cirrus Logic, down an average of 8%, down 17 out of 20 years. Why would I want to be going long there? Lionsgate Entertainment, down 15 out of 17 years for an average of 7%. So for the most part, this is a strong seasonality period. There are some weakenings during that period of time. Just pointing out that I do short, although I'd rather buy contra ETFs, as I've talked about before, and I'd rather buy puts than outright short. The advantage of a contra ETF is in some of my accounts and IRAs where I can't short, it allows me to have a instrument that correlates with shorting the market, but it trades long like a stock. It runs inverse to the movement of what I'm tracking. I like options because I know what my risk is. If I'm buying a put, my risk is the premium I paid. The advantage of shorting a stock over a put is that I'm not paying a 3, 5, 7% premium just for the right to participate in a move down. And the put stock has to move in my way enough and within a time frame for me to take advantage. On a short position, I take advantage of the first penny move down. The downside of a short position is my potential loss is much bigger and my margin hit is greater. But I mean, it's easier, I think, to short stocks than buy puts. It's easier for me to sleep buying puts than shorting stocks. This is my shorting scan in EdgeRater, and I just pointed out that I look for certain things. I want to find stocks that have been in uptrends and have just started to roll over. And I've referred to this chart in the past, so let me bring it up. It's not about gold, so I'm not really looking at gold. Chris Wilson is one of the smart HGSI users who gave this to me years ago. And what it's looking at are a couple of my favorite symbols, favorite things. We'll start down here. This white line is the relative strength, or forget relative strength, it's the S&P 500. This red line is the relative strength of whatever instrument I'm looking at here compared to the S&P 500. So when this is trending up, it means my instrument is outperforming the S&P 500. When this red line is going down, it means my instrument is underperforming the S&P 500. The blue line is a moving average. So I look at relationship of the red line to the moving average, and I'm looking for breaks above and below. If I want to find stocks that are shortable, I don't want to be buying stocks that have the highest relative strength compared to the S&P 500. I may not want to be shorting stocks that have the lowest relative strength because they've already had their move, hence their backward-looking relative strength. How about finding stocks kind of like where my cursor is, where the relative strength of the stock has just dropped below that of the S&P 500. And then what I want to do is I want to combine that with my weekly bongo and a kahuna to the downside. And then these are 10, 20, actually green is 10, blue is 20, red is 40 weekly moving averages. And so it's really a combination that I'm looking for. I'm looking for a recent cross of the relative strength below the S&P. I'm looking for a breakdown against the weekly moving averages. And I'm looking for a confirmation with bongo going weekly and getting kahunas to the downside. So I can't scan for that I'm aware of in HGSI. So I did ask Chris White. Wilson is the guy that wrote the chart. White is the guy that does EdgeRater, to give me a scan here so I could look for crosses below moving average. And what I did here is I've set for stocks to have crossed below the 20 weekly here, and the 0 means it's crossed today. I'm looking for, this is one of the ways we're measuring change of relative strength versus the spider. I like to find things that have recently crossed below. So I might come here. Well, I don't know if I can't do it here. I can eliminate above in Chris's spreadsheet. And then I can look for bongo down. I certainly, if I see it bongo's up, I don't want to be shorting. And I could look for kahunas to the downside and pocket pivots to the downside and low close doji. So I put together a lot of different things. Let's just look at Energizer Holdings. Now keep in mind that it's a different relative strength tool than I had in HGSI. So let's look at ENR. All right, it's too new to even worry about. All right, never mind. So you see the bongo turned green, or turned red. but this is too new of a stock, so that's a bad example. Let's see if there's something else. All right, let's look at Madison Square Garden, MSG. I haven't looked at this already, so it might turn out to also be a bad example. That's strange. All right. So I'm picking out things blindly that don't have a lot of data. I want things that are expensive because I don't like shorting things that are cheap. How about Tribune Media Corporation, TRCO? Also too new. Well, basically what I will do when I get done is I will start to go through these, and Middleby Corp. Let's take a look at this one. That's not a new one. Let's just take a look at Middleby and FLT. Mid and FLT. But you just have to go through these stocks one at a time. All right, here's what we're looking for. Now, had I not, I wish I would have gone to this one first. I would look like I was smart. I'm not saying I'm shorting Middleby tomorrow. What I'm saying is that Middleby is the kind of stock I like to short. Middleby's been a huge uptrend. It's run from August to 12 at about 36 up to 130. It's been in a downtrend. I guess if I squint, maybe I would see a neck, breakdown of the neckline, and the stock is going lower. I think that's possible. Look at the earnings per share slowing down here. Hard to maintain a multiple of 30 when my rates are dropping. There's not an interest rate to support. I went to a weekly bongo down on Friday this past week. I had a kahuna to the downside. I had a long red candle that took out all moving averages, and my relative strength broke down. I might look at my traditional chart on a daily view, and I see that I broke below the 200. Now, what I'd really like to see is I'd like to see the stock rally back up to the 200 and then try and short it off that point. I could also say I could put my stop above that 200 if I was able to short it anywhere close to its closing price. So Middleby looks interesting for me. And you can see on the weekly chart how it's traded down to the 50 weekly. And this might be my target down here, although I'd probably cover it about the same place when it took out this prior area between here and here would be my downside target. So if I wanted to, let's just take a look at well, I don't want to go there. So Middleby might be one of the shorts that I might be considering. The other one looked like FLT, and I haven't looked at it. So let's go to the Chris view. Broke down through the moving averages, weekly bongo, kahuna to the downside. It failed to retake the relative strength line. Looks good. Drop down, take a look at it a daily. Broke through the moving averages here. Again, might look for it to run up, retest, and drop it on the retest. But this is one that also might be a candidate. So the point here was not to show you where to short and which ones to short, nor teach you how to short. In fact, if you want to learn how to short, I recommend my friend Gil Morales' and Chris Catcher. I turned them into one person. Short Selling with the O'Neill Disciples is a relatively brand new book. It's a great book for shorting. But this is just a tool to help me identify. Now, I searched a large universe. I could have gone back and searched and limited to stocks that had been trading for at least 2 years of time, higher prices and higher volume, which is what I typically do from a shorting perspective. All right. Now, next thing I normally do is I start to look at industry group rotation and see if there's anything that really stood out on industry groups. And as you could see here, I got 174 groups. And on the 2-day up, I've got 9. Interestingly, on the 2-day down, I have none. Now that, I scratched my head and wondered, how could I have no industry groups that are 2-day force down? And the answer is simple. And I may redo the filter, but it's basically you had to turn negative on Friday. Well, everything already was negative. So if I look at things that have been down for 5 days, we can see that we've got 92 of them have been down for 5 days. So most of the groups on the 5-day force are down. On the 5-day force up, I bet I don't see very many. And I see one, which is generic pharma. So let's very quickly look through and see if there's anything here that looks interesting. I've got about 10 more minutes, and I'm going to have to say goodnight. So actually, I didn't want to click on that. I wanted to right-click, because there were a couple I liked to generic pharma, I think the first two. So Mylan's been in a brutal takeover fight with Perrigo. I think it's recently, I think Friday it ended, and Mylan looks like it's going to go alone. That may make them a takeout candidate on their own, but look at this, from 75 down to 39. Wall Street didn't like the deal either. Earnings per share growth is coming back into the stock. It had a gap up on Friday with a kahuna. Down here, a pocket pivot, a mobile breakout. Everything looks good on the technicals up top. It's traded above the 50-day moving average. I like Mylan. If there's any strength in the market, this might be one that I might be putting some stupid buy orders in. When I say stupid buy orders, I'm just shooting real low in case the market gaps down. Impacts Labs, I also like this one. Might see some resistance here at the 200, which is only a couple bucks away. Look at the earnings per share growth. This is a turnaround box 7 type stock. Kahunas and pocket pivots. I don't usually look below the index. Specialty pharma, this has been where a lot of the fighting has been in the newspapers about pricing. They're not all the same as Valiant. Endo Holdings, a lot like Valiant from the perspective of acquisitions, acquires a lot of different companies, but none of the same story that you ever hear about Valiant of its own specialty pharmacy to this point. However, downtrend, not interested. Lipocine, I am interested. We'll see this one again. Pull back to the 200. Had a Bible gap up on Friday. I need to know more. It doesn't make money, so it must have some decent things in pipeline. Anacor is an expensive stop. It looks like it's done going down. It bottomed here earlier in the month. Still has to get above the 200 to convince me. Insys Therapy, trying to regain the 50. It's got only a couple bucks away from the 200. Not going to be the one I'm going to chase. Radius Health, probably the best looking of the charts in the last couple. They've got a very exciting osteoporosis drug that's supposed to be approved later this year or beginning of the first quarter. I always like to look at these not the stock price. I look at the chart pattern, but how much is the market cap? $3.2 billion on a likely approved product. This company could be a takeover candidate. I've been hearing that a lot. And yes, I have a position in it. Mallinckrodt's the old Quest Core. Hard for me to chase that thing to the bottom. Precious metals, sort of defensive play. Don't know anything about Tahoe Resources. That's the first on the list. It does trade 1 million shares. Here, what you're seeing is just like the GLD look like, bouncing off the bottom. Is it a place to be defensive? Maybe, but I'm not sure if you can be defensive if the market gaps down. All these things look bearish to me. I'm not buying them because of their own individual benefits. It might be a place to hedge. Biotech. You notice specialty pharmacy, generic pharmacy, and biotech in the first 5. There is strength in this part of healthcare. Vertex, I think, is coming up on some consideration of some approvals of some CF drugs. Really sideways, struggling to retake the 200, but look at the day on Friday. Concordia Healthcare pullback, nice move on Friday. This is an IPO that fell in half after coming out. Prothena, well, looks like Radius, and then it's an uptrend pullback, trying to take out new highs, does not make money. Not a lot of volume, 300,000 shares, probably would pass. The Medicines Company, don't like that candlestick. Insight is one of the best biotechs out there. They've got an amazing pipeline. This is one that you might want to nibble on if the market dumps. So what do I mean by a stupid order? I might stick an order in at $90. On August 24th, here, stock traded down 89.21. On November 6th, it traded down to 90.33. Pretty good bet that if you got filled at $89 or $90, that the stock's going to, not drop to 50. Here they have a marketed product, by the way. Here the low of the day was 89.37. So why not stick an order in at $90 and buy some shares at $90, and then watch for a snapback and sell them for $105 the next day? That's what I mean by putting in stupid orders. I hope I don't get filled at $90, because it means the rest of my portfolio is getting killed. But wouldn't you like to buy something at a big discount? It's Black Friday coming up. That would be a great opportunity. Kite Pharma, a leader in the group right now. I have a position in it. Really doesn't have any product to sell right now. They do have a little bit of revenue. I think it's from licensing. It's probably 2017 before they get a drug to market. $3.5 billion. Somebody's going to be doing some takeovers. Gilead, Amgen, and others have a war chest of cash. It wouldn't shock me to see Kite becoming acquired by somebody. Agricultural chemicals, the materials I mentioned, specialty chemicals, fertilizers and others. Syngenta, this was a Monsanto potential takeover, crop protection. That takeover stopped, had a pocket pivot, kahuna, mobile breakout, squeeze Bible gap up on Friday. If there was strength in the market, one would expect Syngenta to go higher. Monsanto also looks like it's on the move up after dropping its acquisition bid. Mosaic, CF Industries, fertilizer companies don't look so hot. SQM, a Brazilian fertilizer company, looks a little bit better, trying to break out here. These are all beaten up, or many of these are beaten up. Speaking of beaten up, oil exploration production. At one point Friday, it looked like natural gas was up. I didn't see how it finished. Maybe we'll take a look. Some of these are heavy natural gas players. Encana. Have these bottomed, or is oil going down to 35? Range Resources. You're buying these, in my mind, because you believe that someday oil is going up and that you want to have a position in oil and gas for when that happens. You're not buying them for a return tomorrow. Natural gas was up 3% on Friday. That's probably causing some of these natural gas players to have bounced a little bit as well. Are these market leaders right now? No. Commercial and residential building and equipment. Just a couple things here. Let's take a look at them. Acuity Brands. This has been a leader. I look at a weekly. Wouldn't you like to have been in this stock? What a nice, tight-looking chart. From 55 to 200 in 3 years. Big uptrend, small pullback. I'd like to see some momentum coming in. It's got great earnings per share growth. This has been a great place to be. Energy Focus, not such a great place to be. This is another with great earnings per share growth. They did a weird IPO here, secondary, like $3 or $4 in the money, and the market just sold off. Why would you have to give away shares? This is a stock that, if I go back, I'm betting to here, there probably wasn't a lot of volume. Volume of 1,500 a day. Volume of 12,000 a day. Volume of 43,000 a day. 93,000. And then you get here to 600,000. So volume just took off of late. Reminds me a lot of Plug Power. You got to use these things at your own risk. And LSI Industries, a nice looking chart, crazy looking day here. With a range between almost 12 and less than 10. So that's about 20% range in one day. I don't like that pattern, so I would probably just not pursue that. I'm not finding a lot to buy. I think you should see that. Marine shipping, big dividend players on several of these. This is a place where oil is floating around the Gulf at $1 a barrel a day. TK Shipping, 7.7%. Earnings are out. Next earnings are in February. Bouncing off the bottom, not exactly a great looking chart. Dorian LPG, no dividend. Scorpio Tankers, 5.7%. TK Tankers pays only a 1.7, but has good earnings per share growth, bouncing off the 200, probably a lower risk place to buy. Let's see, here's one that I like. Ardmore Shipping looked interesting. Very loose looking chart, pays a 9.7% dividend, great earnings per share growth coming in, but sloppy patterns. And then coal operations. Well, the world's in trouble when coal makes it to a buy list. Maybe it's regime change coming in Washington. Consolidated Energy, CNX, failed at the 200. Big downtrend, hard to be excited to jump into a coal stock. These are stocks you buy if you believe that there's a story for long-term coal. There probably is. That you're not going to look at your statements for a long time because you're unlikely to see a big move. But you believe that coal will come back. And if that happens, then you have an opportunity to participate in the recovery. You just don't know where that recovery is going to come from. Here's Alliance Resources. It pays a 14% dividend. That's a pretty impressive dividend. So whenever I think of coal, I think of things like Walter Energy, not even traded anymore. Cleveland Cliffs, iron ore and coal. And every time I would think that this one was going to become a value, it gets even better value. Just hard to predict. Remember that pattern I said that every stock goes through? It's been through that pattern a couple of times. This is a monthly chart on Cleveland Cliffs. Yeah, it's probably getting close to a low, but how long before it takes that low out and actually goes higher is the question. What else do I want to show you tonight? Obviously, I'm not showing you a ton of great stocks. My buy watch list is so small. Let's just run through that real quick. I got a couple more minutes and then I got to get off. Many of these you've seen already. I'll tell you why I picked them and what I like about them. Mylan we looked at already. If I was doing a stock of the week, I'd either pick Mylan or Berry, which is probably the next one. Berry Plastics is in that materials group, container and packaging, no dividend. It makes money and is growing. Sort of a flat line. I like the pattern here. It's breaking out at a bottle gap up, mobile breakout from a squeeze. Everything is green, pocket pivot, and a kahuna. Impax Labs we looked at already. Liposign we looked at already. Acorn is another one of these generics. This one scares me because they've missed earnings reports every time since February because of some accounting irregularities. Because of those accounting irregularities, the stock is sold off from the 60 down to the 20s. Rumor has it they're going to come out with earnings this week. This is when they put all their bad stuff in and they start over. And you could see they've got some good earnings per share growth coming. And somebody must believe in them because they traded down earlier in the month to as low as 19. And they went out on Friday on a bad day at 28.57. Eagle is a company that's going through the change from a discovery to marketing. So they're going to have increasing expenses coming in. But this is when companies seem to take off in my book. Look at the earnings coming in. Trades 300,000 shares a day, which is part of the problem. If you buy options, they are thin and tough to get out of, easy to get in, as long as you pay too much. Service Master, consumer discretionary, pest control, reconstruction, not a growth sector, pullback, looks like it's wanting to come up here, looking green up there. Not a great stock. I don't know why I picked it. I wouldn't pick it again. Martin Marietta is one of several concrete stocks buying off the 200 here. Stop just below the 200. Valeris is a Central America, Latin American, or Mexican airline. I can't remember which one. This could be one that I would be setting a buy stop above the PSAR. Again, I'm not doing that because of concern about the market. Huron Consulting. Don't know why it got hammered here. Probably missed earnings. Broke above the 17 and the 8. OBV looks strong. Had a mobile breakout. I love the earnings coming into the stock. Much higher than its multiple. Not a great chart. I'm more interested in the value side here. Freight Care America, a lot of discussion about restoring rail cars and improving them because of the oil and energy. These have all sold off with the railroads. There's still a lot of legislation that's going to require some significant improvement in the rail cars and rehabbing. And this is one of the companies that does them. Look at the earnings per share growth. It pays a small dividend, a small multiple. If this group becomes in favor, one would really think that this has got the power to explode. Cross Country Healthcare, which was at one point one of our charts of the week. You could see it runs up and dies, runs up and dies, runs up, and hasn't died yet here. I doubt this time is different, but look at the earnings per share growth. Walker and Dunlop, this is purely a chart that I like. Pull back to the 50, had a positive day on Friday, has earnings coming in. Specialty finance, I need to see some momentum, like a Kahuna, Pocket Pivot. We looked at Ardmore Shipping. Here's another specialty finance. This asset management pays an 11.5% dividend. Has moved off the bottom $3 already. Does make some money. I'd have to do some research and see if they have enough cash to pay their dividend. But I like that dividend. And that was it. And then just very quickly taking those, I ran them through John's work. And these were some of the ones that looked interesting to me. That's not today. That's something different. I want the screener. Here's Barry. What I showed you before on a regular chart. Look at the OBV, just breaking out. All my indicators firing off on the daily and the weekly PPS buy. Daily and weekly, if this market was going up tomorrow, I'd want to be in Barry, but I think the market's the problem. Here's that rail car, PPS weekly buy. Daily buy, high close doji, but that doesn't count because it was already in an uptrend. OBV is strong. Impacts Lab, daily and weekly buys. OBV trying to retake the moving average on the weekly. Looks great on the daily, coming out of a squeeze. Again, if the market was strong or was not getting killed tomorrow, Impact Lab looks good. Here's LPCN. Really like this pattern. A pullback here, but OBV leading the way up both on weekly and daily. Look at all my signals firing on the daily. PPS daily and weekly buys. Great looking person signal if I thought this market was going up. Notice how the histogram got less negative as the stock was falling. We call that convergence. And then Mylan Labs. Again, OBV really taking the stock higher. Lots of my signals firing. High close doji on a PPS weekly and daily buy. Again, Mylan, Rail, Barry, all these stocks could have been a chart of the week if I thought the market was not going to implode. I'm concerned about the market, and hence I did not take any of these picks. On that note, I'm going to say goodnight. Have a great week. Be careful tomorrow morning. Remember, it's where the market closes, not where it opens, and try not to be that one that stopped out before at the low of the day or what could be the low of the year, for all we know. Good night, everybody.